Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold, copper, uranium and oil in a separate video. I'll leave a link for that in the description section below. As always, this general commentary doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got a chart of the SP 500 up on the screen. And it's been a quiet week, but nonetheless, I think it's been a positive week. S&P 500, it's really barely moved in the last few days. And for that matter, it hasn't done much since. You've got to go back to the 22nd of November. So that's about 2.5 weeks ago. It's market's really been trading in this tight 1.4% range. I think it's positive that it's been holding on to its gains from the lows in October. So big rally from the October low, and market's really been holding on to those gains. So for me, that suggests the underlying interest is to buy, and is to buy the market in any sort of pullback, and we're not really seeing much of a pullback at all at the moment. And it's interesting. You only need to look back to 2022, where it was a case that every rally was pretty much a distribution event. Market would rally, get distributed into, and would get another sell-off. But what we're seeing now we're seeing the market being underpinned, and the dips being supported. So I think that's a really important change to the underlying structure of the price action, that we are getting the dips being supported, and that the rally is not, at this point, being seen as a distribution event where it gets sold into. I've been thinking for the past couple of weeks that maybe we'd get this dip back towards the moving averages. That's often what you see when you get a market that goes from below the averages up to above the moving averages. You often get a pause, you get a pullback to the averages. Doesn't always happen, but it is a fairly typical sort of price action that we look for, and that so far hasn't happened. It still could happen, but I think the play here is very much to approach this market from the long side, and the longer this price action trundles along sideways, I think it just provides a stronger base, a stronger platform to potentially move higher from over the coming weeks. And it also gives the moving averages a chance to catch up. So if the market's not going to come back to the averages, if it treads sideways, well, gives the averages a chance to catch up. Rather than, like, the question then becomes like where do you get your exposure? How do you get into this market if you're not already in, or how do you add to exposure? I think my preferred way of playing this is to look for stocks, look for the individual stocks that are breaking out of ranges, that are rallying off moving averages. I think that's where some of the better asymmetric opportunities can come from. It may take a bit more time for the S&P 500 to give us that price action that does give us that clearer asymmetric entry point. At the moment, it is a little bit difficult buying it, given that it is still stretched above those moving averages, and it has had those big rallies. So maybe those individual stocks do present the pathway in. Having a quick look at the Nasdaq. Now, this could be part of what we're seeing here in the last week. This could be part of an ongoing flagging formation, which is tracing out. So just to draw something in. So for example, maybe the market needs a couple more weeks where it just goes sideways, and then from there we can look for more upward price action. That would be, your classic flagging type pattern, where you get the price action moving in that narrow downward range. Look, that may not happen. It's just one of the possibilities that we can keep an eye out for. And if we did get price action like that, it does help us understand where entry points can be and where we can manage risk from. So we're buying breakouts and we're putting exit points beneath breakouts should the breakouts fail. So a little bit more price action could help in identifying where the opportunities in these markets could come from. And I think that really, it's a case for me now of, yeah, just looking about like how we manage risk. It's like continuing to add to that exposure, which hopefully you probably would already have on board, and but then working out like how do you manage the risk around that. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just hey, thanks for the video. Just tells YouTube you're watching. YouTube shows other people, which helps me a lot. So please do that and hit that subscribe button if you haven't already done so. So now let's move on. Let's move on to. I want to show you something else. I want to show you the S&P 500 equal weight index. So this is interesting. So while the S&P 500 has had a fairly quiet week, the not so much so in the S&P 500 equal weight. You can see last Friday it had a really nice kick higher. And more importantly, those moving averages continue to turn upwards. They haven't crossed yet, but they're getting very close. So I've got the 50 and the 100-day moving averages. And also just looking at the price action over the last few days, it's really compressing into a tight little range. So that suggests to me there's interest in buying any weakness, and we're not seeing much weakness at all. So the interest does seem to be accumulate on any pause. And I think for me, this is just another sign that the path of least resistance is to the top side. It's I think the next target level for the equal weight would be these previous highs, the July high and the February high. I think they become the new target points. And if we just have a look at going over to the small caps, looking at the Russell 2000, and this is also interesting because it's similar to the equal weight, the S&P 500 equal weight, in that it also saw strong gains last Friday. And what that did, it propelled the index above this resistance point. We had this overhead resistance coming in around 1,820. That has been a technically active region for much of this year. And the other thing it's done, it's really given the market a good push above the moving averages. So again, the 50 and the 100-day averages, which also are turning upwards, haven't crossed yet, got a little bit more work to do, but they're certainly heading in that direction. And it's really been the small caps which have been out of sync with the larger stocks for much of this year. So I think it's a positive development that we're starting to see this positive price action start to come into the smaller stocks, because that's been the missing component of the rally we've had in the big stocks. We need, I think, for that healthy overall market, you need the broad participation, and this is where the small stocks come in. Now, one thing I want to do on this chart while I've got it up here, I want to, like, for months and months now, I've had this blue downward trend line, which is connected, initially connected the high from August 22 and the high from February 23 this year. Had a bit of a false break above there in July, then the market fell away. I've been looking at this and thinking, look, what am I going to think if the market gets back up to this trend line again? Am I going to call that a valid trend line, given we do have this false break in July? And I think the more valid area to watch now is this overhead resistance at around 2000, which takes in the highs from July and February and August last year. So this blue shaded area, I think that now becomes a key reference point, and this is where the market potentially can move towards over the coming weeks. So whilst this has been a useful line, I think it's always good to review the analysis that we do on the chart and the lines that we have and the indicators they have. And we think, look, why are they there? Do they still have a purpose? And I think for now, it's a case that this line is, I think it's best removed, and we're going to use this upper boundary here for the Russell moving forward. And now I'm just going to wrap up. I'm going to wrap up with the 10-year bond. And what's interesting in this is that it continues to decline. The yield continues to decline. And this is something we spoke about several times in October, early November. You see this green line above. So we had the rising price in the bond. But when I had the RSI on, I won't put it on now, we've seen that before, we had the divergence in the RSI. So the RSI wasn't making new highs where the yield was. And that's turned out to be a really helpful signal. And it was also used in conjunction with this overhead resistance, which is at 5%. You've got to compress the chart for a long way to show 5% as being resistance, but it's a big resistance point coupled with divergence. Key is now, so that's all been well and good, but what's going to happen now? So we now find the yield is below the moving averages. Moving averages are starting to round over and turn to the downside. I think the really interesting thing to watch now is what happens. What happens here? Does this yield consolidate below declining moving averages, which then can potentially set the stage for another move lower? But I don't know what's going to happen there. It's a case of watch and see how the yield now behaves. Now it's below moving averages, which are turning to the downside, because this move so far lower has been a tailwind for equities. So it's going to be it's one of these things I think which is well worth watching over the next few weeks. See how the yield performs with the moving averages. So look, let's call that a wrap for this week. Thank you for joining me. Great having you with me. Hopefully that's been helpful. Please give me that like and look forward to coming back and talk to you next week. Till then, bye for now.